Hello and a warm welcome to Econoday Unplugged on Tuesday, the 23rd of March 2021. Mark Pender is stateside and I'm Jeremy Hawkins in London. The March FOMC meeting saw the Fed sharply upgrade its growth forecast for the US economy, but at the same time, officials indicated they expect to keep interest rates close to zero until at least 2024. And for some countries, it's looking increasingly important that they do this indeed, because with US yields higher, the 10-year Treasury note last Thursday broke above 1.75% for the first time in 14 months, and a stronger dollar, at least in part responsible for triggering interest rate hikes in Brazil, Russia, and Turkey last week. Clearly, some countries are looking over their shoulders very much in the direction of what the Fed might be doing. Since then, yields have generally fallen back again, but some 46% of members just surveyed by the National Association of Business Economists now predict that the Fed will tighten as soon as 2022 due to rising inflation risks. Someone's wrong. So, Mark, whose side is data coming down on?
Well, it's interesting about the economists. That's a higher proportion than what the Fed's members see. They're 18, and there's a few, just a handful, that are seeing the chance of a rate hike, not so much next year, but then the year after that. So it is in play, but the basic idea is that it's kind of a whipsaw on the data, and you're kind of seeing that right now if you just look at the stock market year over year, lapping these easy comparisons. So like the Nasdaq is literally up 100%, and you're getting that same. We will be getting that same kind of effect when the March economic data begin to be released, and so you're going to get this. So they up their forecast for that, but then it comes right back down to where originally essentially was before, a little tiny bit 3 years out, a little bit tiny higher, but not a fundamental at all. Kind of as Powell put it last week, or kept emphasizing, it's a transitory effect. So, and Powell's on the speaking tour this week, or the testimony tour this week as well, at Washington, and he's, and he just got through talking at length about the economy, so we can pretty much expect that he's going to be saying that they'll be supporting as long as it's necessary, and that the economy still has a way to go before recovery. Yet, there's, and as he did last week, that he's likely to stress a lot of important positives about COVID here in the U.S. Vaccinations up for the most part, and cases way down, but he's still going to be. And he emphasizes this. There is in the U.S. monetary policy, at least at the surface, there is a big demographic, progressive stress, and so until the lower wage group, which is being disproportionately hurt by the COVID effects and public-facing services, until that group recovers, they're going to, so that's where the focus is right now, at the very lagging part of the labor market, which will then push back the moment when they do begin to warn everyone that they will be beginning tapering or thinking about raising rates. So I think it's pretty much for right now, status quo for the Fed.
Okay.
And
let me ask you about, I saw some stuff today talking about some of Joe Biden's advisors talking about giving him a new infrastructure. Well, it's a heavy-duty infrastructure spending plan, from what I could see, which could reach the best part of $3 trillion. Surely something like that would have to have an impact on the Fed if it actually comes to fruition.
Right, if it actually comes to fruition, and that's going to be at the beginning of they're at the beginning of talking about this plan. So I think that's going to be further down the road. I imagine it's going to be well greeted. If we're turning back to the Fed, Powell just has nothing but lots of very positive comments, not only about monetary policies and its effect and its success, as he would say, but also the force and timeliness of the fiscal package, not only last year, which was started last year, but also now this new package that's in the mail right now, that's being distributed right now, which is going to create another ripple effect inside another ripple effect. And this is going to be a monthly one. So we were talking about a year-on-year comparison of volatility. Now we're talking about month to month. So that January, which was a big stimulus month in the U.S., retail sales up 5%, everything, consumer stuff, through the roof. Then February, because you're comparing it with January, then it plummets. Now you're going to get the same thing again. You're going to get a March that's going to be amped up by these fiscal stimulus, and it has a big effect. And then you're going to have April and May, whatever that effect starts to fade, and so you're going to get this real bumpy, however you look at it. But like I said, if people are looking past that, and as far as other fiscal stimulus measures, I'm sure that they will all, as long as people are showing up to the Treasury auctions. And we have some runs, a heavy week schedule there. As long as those go orderly, even though the bid to covers might be historically high, that's okay. But if they're orderly auctions and people show up to them, then there won't be any interruption in these plans for as maximum fiscal stimulus to match how maximum monetary stimulus is.
Okay. Round off then from your side. What about this week's numbers? What have we got to look out for?
Well, let's talk about Econoday's Consensus Divergence Index, which for the U.S. has just been fumbling through the floor, just at an incredible rate. We had new home sales today that came in below the low estimate. We had existing home sales yesterday. And I know they were lower than expected, and I'm just confirming on my calendar here, Econoday calendar, that they indeed were lower than the low estimate. So this reading now is at minus 48 for the U.S., and that reading was plus 30, we're approaching plus 30 just a couple of weeks ago after that big February employment report with I think it was like 349,000, something like that for payroll growth. And usually, the employment report, which is released at the beginning of the month for the prior month, it's the first big, by far, the first big economic indicator. Usually all the other ones, if that's good, then the ones that follow, like retail sales, industrial production, housing, all that stuff, they all kind of follow in and a good showing, but not this time around. So as this other data, U.S. data, has unfolded, our indicator has collapsed. So
interesting.
Yeah, it is interesting that the forecasters have completely missed it. They completely missed the effects that we're just talking about, these monthly effects, and in February, and they underestimated just how badly a lot of these numbers compared against January. And I guess we're going to see the same kind of disruption again appear. But what's interesting is the whole band of economists that we cover, and we track 20 in their forecasts. They, usually I say only good things about the sample, but not this time. They're missing it completely. Can't get them right all the time. Yeah. So, but they're at least it's uniform, and but I guess behind all this volatility is basically just wait and see until the dust clears and this fiscal stimulus takes hold and vaccines take hold.
I'm going to quickly interrupt you on this. I mean, it's interesting. It's the fact that you've got the key big report, which has sent out completely different signals on the economy from how the individual various other reports have come in. Does that hint that perhaps we could get a big downward revision to the payroll when we get the update next time?
It does. I think there's not a lot of revisions in the payroll numbers as far as they're getting the data. Their seasonal adjustments change, and then and that has a significant effect. But I think that's a little bit separate from what your question was. But I noticed something interesting in your coverage of the UK labor market report, which is a very difficult report for me to get a hold of. But
join the club, yes.
At the end of it, and you're talking about Econoday's index. You make the interesting thing in the UK's in contrast to the US, the UK has been in the 20s, in the plus 20s, and has been beating expectations. And you make the comment that it suggests that the expected contraction of first quarter UK GDP may not be as steep as expected, which is an interesting comment. So if the US data is significantly weaker than expected right now, then it would, it would be reasonable to assume that existing longer term forecasts may not be, may also, or may be too strong,
Yeah, I think that's right. I think it's also, it's consistent with what we're seeing in the bond market now. We did have the big rally in yields back in the last week, but we've seen those yields come off quite significantly over the course of the last several days. And that, of course, is in keeping with outturns of economic numbers, which have been, as you were saying, well below what the market was anticipating. So that certainly should help to cool some of these inflationary worries we have in fixed income markets at the moment. But you're right. I mean, the counterpoint to that is from the UK side. For over a month or so now, really, our divergence index, which looks at the economy, proxies the economy as a whole, has been suggesting it's been outperforming market expectations. And I think ever since the Bank of England came out at the meeting before the one last week, they intimated that they saw UK GDP contracting just over 4% on a quarter-on-quarter basis in the current quarter. That tends to become automatically the kind of median estimate in the market before we really get any figures coming through. But I think as we've gone through this quarter so far, by and large, the numbers have come in on the strong side. So it really does suggest, it may not be the case, of course, but it does certainly increase the likelihood that although it still looks as if we'll see a contraction in the first quarter total output over here, it won't be as steep as originally anticipated. And if that turns out to be the case, then it should be more good news as far as the pound's concerned.
Well, what does that now say for what seemed to be a big concern about the unknown Brexit effect? And it seemed to be greater than expected in the earlier data coming out of the UK, and also was it also coming out of Germany too, in a mirror form? So what is it that we should expect Brexit, the first quarter Brexit effects to be?
Well, they're going to make interpretation of the trade numbers particularly difficult from both sides. I mean, I think last week we talked about, as you were sort of alluding to, the collapse we saw in some of the UK trade numbers in terms of exports going to the European Union and imports coming out of the European Union. Well, we had the Eurozone figures, their counterpart numbers released back into last week, and they showed exports from the Eurozone going into the UK down 31.2% on the month, but exports to non-UK rest of the world up almost 5%. And imports from UK down 57.5% and non-UK up 4.1%. So the bottom line to all this is it seems as if the Brexit impact on top of whatever this COVID impact, which is clearly still in the data somewhere, this Brexit impact has been significant on both sides of the channel. Now, what the net of it is going to be in terms of implications for GDP at this stage, to be honest, is pretty hard to say. But I guess you would tend to think that, well, in as much that UK exports going to the Eurozone is a much bigger share of UK GDP than Eurozone exports going to the UK is of Eurozone GDP, it should make for some downside bias in terms of UK GDP. But obviously, there are other factors involved at the moment.
Well, what about the administrative and bureaucratic factors? I mean, are there special seminars being given in London for professionals to figure this out? And is there any energy on the counterpart in the European side to learn the new rules?
I think there has been, but I suppose part of the problem at the moment, if we just sort of roll the clock back a little bit, is that because the whole outturn for Brexit was so uncertain for so long. And initially, we didn't know Brexit was actually going to take place. I say initially, that lasted a long time because there was so much talk about the possibility of a second referendum, and the opinion polls are moving in the direction if we do get a second referendum, we might vote to actually remain part of the European Union. So a lot of companies, I think, were kind of, let's wait a moment and see what the outcome's really going to be before we start making any kind of fundamental shifts in the way we're looking to trade between the two regions. And because this thing rattled on for so long, if you remember, all these talks went right down to the wire. We didn't actually get the sort of the agreement come through until December of last year, just before this transition period actually ended. It's left companies really just, their hands up in the air in the grass, simply not knowing what they're supposed to be doing. And when they finally got the trade deal announced, well, it's hardly the biggest deal in the world, and it has meant there's an awful lot of additional paperwork, as you say, and red tape, customs border checks and so on having to be introduced now, when really it comes down to the case of a lot of companies simply weren't ready for it. So the governments on both sides of the channel are maintaining, well, this is just a temporary problem. As companies become more used to the new trading environment, then the changes will be adopted and things will start to come through more smoothly. But that's going to take a little while. So I think it's reasonable to assume that the monthly trade numbers in particular are going to be very volatile over the course of the next several months or so.
Well, just real quickly, I mean, are the new laws clear? I mean, are people saying that this makes sense? Or are they people saying we can't figure it out? Or
I think the honest answer to that is sort of yes and yes. I think by and large, for larger companies, I think, who have the greater pool of funds to actually invest and make sure all their new administration rules are up and running appropriately, they're probably doing okay. But for the smaller and medium-sized businesses who don't have so much spare cash to throw into this kind of thing, they're struggling at the moment. So it's going to be the smaller companies which, if anything, are in danger of perhaps, worst case obviously is simply disappearing altogether, or at very least only building back up to full capacity in terms of what they'd normally be doing in the fullness of time.
Before we were recording, you mentioned COVID difficulties in the UK. Or is the vaccination? Fill us in.
Yeah, I mean, this is important, I think, because it takes us back to sometimes why the current economic numbers don't always work. And even with regards to, we talked about our economic consensus divergence index, looking at the US one, as you were talking about, it's quite deep into negative territory now. So it means, the US economy is bottom line underperforming expectations. So you expect the dollar to be somewhat weaker. However, the dollar at the moment is having a very good ride against the euro. And part and parcel of that is because of what's happening to the vaccine situation in continental Europe. So the rollout rate there continues to be decidedly slow. That's due to a combination of factors, including, the EU Commission, which tried to centralize it, actually put the orders in for the various vaccines. I think it's best part of 3 months behind the likes of the UK. Of course, the rollout has been much faster. There's been problems with supply coming out of the actual manufacturers themselves. And also, it seems now there's what is developing into a vaccine war, whereby continental Europe is effectively, by the EU Commission, telling the UK that they may have to consider banning exports of the AstraZeneca vaccine, which is produced in Belgium, going from the European Union into the UK, simply because the UK is so far down the vaccination road at the moment compared to what's happening in continental Europe. And that, interestingly enough, has hit the pound. So, going full circle on this, for so long now, the pound has been riding high on the foreign exchange markets. Indeed, it's been perhaps the best performing of the major currencies so far in 2021, because the UK vaccination rollout has been so rapid, and particularly compared to Europe, so much faster. But now the merest hint that, if we do start seeing a ban on exports of vaccines being made on the continent into the UK, that's going to hit the vaccine rollout in the UK, and all of a sudden we've seen a little bit of selling of the pound on the back of that.
What does Boris Johnson think of that? I mean, do you guys say, we are way ahead? Let's let
there is that. I mean, there's all sorts of issues going on here, and I think one of it's certainly true to say that the EU Commission was so late in actually getting their act together on this. Part and parcel of it was the fact they wanted to try and centralize it, which I guess you can say is fair enough, since we're supposed to be talking about the EU or EU as a whole, rather than allowing individual nations to do their own thing. So it did mean that when these orders were actually sent in from the EU Commission, they were long behind a lot of other companies. So the UK is in a difficult position at the moment. I mean, it's lucky in the sense that it manufactures a lot of its own AstraZeneca in Oxford and around Oxford itself, where the thing was actually put together in the first place. But it also is looking to import a lot coming out of the EU and also out of other parts of the world as well. So it wants to maintain that flow of a vaccine to the best it possibly can. So as I understand it, Boris Johnson is supposed to be having calls with a number of EU leaders during the course of this week to try and make sure that this flow can continue as uninterrupted as possible. Now, exactly how it's going to turn out at the end of the day, we really don't know. But the situation is complicated by the fact that a lot of continental European countries were refusing to use the AstraZeneca vaccine when this report came out of Norway linking it to blood clotting. Now, although that appears to have been ruled out now by both the European Medical Association itself, as well as I think from your side and certainly from the likes of the UK, the official medical guys over here, it seems that enough damage has been done to consumer confidence or would-be patient confidence in continental Europe that even though they have vaccines, the AstraZeneca vaccine available for distribution there, a number of people are simply saying, we don't want it, we don't trust it, we're going to get blood clots. So you're in this ironic situation whereby the vaccine rollout in the continent is still horribly slow and worryingly slow. And yet you have stockpiles rising in the likes of France and in Germany because they got this stuff, but they can't actually distribute it because people won't take it.
Okay, well, I guess the question I had, but that's interesting. But I guess as a side question, what's the level of empathy among the British populace toward their European unvaccinated comrades?
Well, I think, without trying to be inward looking, I think the UK at the moment, because touch wood, it has performed the vaccine rollout well. It's looking, further down the road we start to get the easing of a lockdown at the back end of this month. And then in theory, by pretty well June time, the UK economy is supposed to be as near as damn it fully open. And there's no way continental Europe's going to be in that kind of situation at that stage. But as Boris Johnson was saying, really, I mean, it's all very well for the UK perhaps to have achieved its end goal to the extent you can do that. But so long as you've got high cases, and at the moment it's high and worryingly rising cases of the virus on the continent, that's only a few miles across the English Channel. The risk is that it's going to be imported in some shape or form at some point. So it really is the case you need to see as much of the world being vaccinated as possible before you can really feel secure, wherever you might be living.
Okay, one last thing, and that's Northern Ireland. If frictions increase between the EU and UK, what does that mean for the North Ireland border?
Well, we don't know at this stage. At the moment, I mean, this is something which is still effectively being discussed and still trying to be sorted out. So just to quickly remind people, Northern Ireland came out of the European Union along with the rest of the United Kingdom when we had Brexit. However, no one wants to see a border between Northern Ireland and Southern Ireland, so across the island of Ireland, for all the political reasons we've seen in the past. But it's very difficult to maintain an open border there and still allow goods to flow in from what is effectively, now a non-EU country, which is Northern Ireland. So there's been a lot of friction about what is currently effectively now a border between Northern Ireland and the rest of the UK.
So is that a point of leverage for the EU to get what they want on the vaccine issues?
I don't think so. They've already made some fundamental errors over the course of the last few weeks. So no, I don't think it is. And I think, to be honest, both sides at this time are trying to downplay some of the political fallout from this as much as they can do. And the bottom line here is it really is a right raw political mess, which was never sorted out in the first place. And really it was something, it wasn't, almost an accident waiting to happen. So that really does still very much need to be addressed. Okay, what else should we be saying quickly from my side? As Mark's mentioned, we'll get flash PMIs out this week, which, as far as Europe's concerned, is, amongst the most important numbers of the month. And just quickly to say that, effectively, no big changes inspected that the headline composite output index for the Eurozone as a whole, that fell sharply down to 45.3 in last November and has remained below this key 50 growth threshold ever since then. So say still very much in line with the contraction in first quarter GDP, although quite possibly from what our economic divergence, consensus divergence indices are telling us, it still may not be particularly sharp. But in any event, looks like first quarter GDP is still going to be negative. And just quickly going back to the COVID situation, as a result of these sharply rising cases in a number of countries, Germany yet again has extended its lockdown. That now runs through to April the 18th. And France, which has avoided introducing a third lockdown, finally succumbed, and that has now introduced a month-long lockdown in some 16 areas. That's going to affect about 21 million French people. That came in last Friday, and that's going to run for a month. So having expected the first quarter to be a bad one, and then hopes for the second quarter to start seeing things turn around as the vaccine rollout goes, there's now clearly a risk that second quarter GDP in the Eurozone is going to be disappointingly weak too, with whatever implications that might have, of course, for ECB policy and indeed fiscal policy as well.
And we have some indications in the month of March, anecdotal ones coming with the PMI flashes for March, and that you have France and Germany opening, and and then followed by the Eurozone. And what I guess where the general consensus is a continued strength in manufacturing offset by COVID-related weaknesses in services.
The headline composite output index, the consensus is at 49.1, so sort of borderline stagnation, if anything, contracting output. But manufacturing up at 57.7, so still a good period for manufacturing. But the key services sector down at 46, so essentially still in recession. So it's still a pretty grim time. And of course, this is for March, when a lot of these countries have been largely shut down anyway. And the worrying thing now is that this shutdown is going to be extended into the second quarter as well. Okay, before we prattle on for too long, quickly round off a couple of central banks. One from last week, which is very easy, is the Bank of England. There was no change there whatsoever in terms of policy, which came as no surprise. But if anything, the B of E was, again, slightly more optimistic about the second half of the year due to, surprise, surprise, a vaccine rollout. So again, that further reduces the likelihood of any additional easing out of the Bank of England. And this week on Thursday, we'll get the Swiss National Bank, where again, no change is expected. It's interesting looking at performance as ever of what the Swiss franc's been doing in the foreign exchanges. It's weakened during the course of this year, and so that's certainly relaxed some of the pressure on the SNB to come out and ease again. So very much strong expectations. We'll see their key policy rate left at pretty well the lowest in the world, I think, at minus 0.75%. But still, they'll almost certainly come out and say that the currency is too strong, notwithstanding the losses it's made so far during this year. Anything else we should be mentioned? Turkey. I will mention Turkey because it's an interesting one at the moment, although it's not part of the world we normally talk about. As mentioned in the intro, they raised interest rates last week by some 200 basis points. In large part, that was due to these knock-on effects we've had on some of these emerging market currencies from the rise in US interest rates. Whereupon we saw President Erdogan again sacking his central bank governor, who he appointed not very long ago. I think that's about the third one he's sacked now in a space of not very long. I think it's since about mid 2019. And he's introduced a person, a new central bank governor, who is of his ilk, which means he sees higher interest rates will lead to higher inflation. Now, the Turkish lira plunged over 15% on that news. The stock market absolutely disappeared down the plug hole as well. And there's every expectation when we get to the next central bank meeting in April, if not before, the new central bank governor will unwind the 200 basis point hike we saw in interest rates last week. So at the moment, Turkey is in a right royal mess. And given the problem we have with longer dated yields at the moment, if we see them starting to back up again, there could well be some nasty contagion effects spilling over from that. And if we see that, then that's clearly going to be good news for the likes of the dollar and the other safe haven currencies as well. Now, Turkey is a bit of an outlier at the moment, but I would suggest it's a country worth keeping an eye on. Okay, that is me. Anything else from you, Mark?
I guess let me just look at my calendar here, and until we get, I guess, employment the end of next week, there isn't going to be a lot of super. We get the core. Well, we do get the PCE core price indexes as part of the personal income and outlays on Friday. I don't think that we're going to see any surprises. I think that the core readings in the U.S. have been, the headlines have been up because of energy a little bit, and then you get to the core readings, and they're kind of coming below expectations. In fact, part of the reason that our consensus divergence index for the U.S. is so weak is because of some of these core inflation readings. So, and you're getting a UK CPI and PPI for February. This is the first read on February.
Yep. Where are we looking for headline CPI inflation out of the UK? 0.8%. So that's just up a tick from last time. So again, it's more a case of we got these rapidly rising or have been rising inflationary expectations, but not a lot of support from the actual hard data themselves.
Yeah.
Okay, then. Well, let's wrap it up there before this thing goes on far too long. So on behalf of Mark and myself, thanks as ever for listening. Podcast will be back again next week. In the interim, everything you need to know about the key market moving data and events can, of course, be found in Econoday's global economic calendar. We'll see you next time. Bye for now.